So this is a stock that I did many videos on, and it's actually PayPal, and I have been trying to stay away from PayPal. I was tempted to buy it, but I found other opportunities in the market. So thankfully enough, I haven't bought PayPal in my own portfolio, but I did make this video on PayPal 3 months ago, and I said PayPal is a good buying opportunity around $64 per share, as you could see in my thumbnail. And now, funny enough, it's pretty close to 64. It's around $65 per share, and the stock topped out somewhere around $310 per share in 2021, and now it's sitting at $65 per share. And it actually reminds me of Meta a little bit. I see pretty much the same bad sentiment around the company, and then in 2023 Meta is one of the best performing stocks in the stock market. And I have to be honest, and maybe this is the first time I say this, that PayPal is starting to look very, very interesting to me at such prices. I'm going to tell you why in today's video. I'm going to give you my valuation model and a price that I believe is a good buying opportunity for PayPal. Now, if we look at the earnings report, I don't believe earnings were as bad as people were actually expecting. They did a pretty good improvement in terms of cost, discipline. They cut a lot of costs. I believe they still have some rooms to go in terms of, laying off people and a few other things. But revenue did grow around $7 billion, around 8.6% at spot. They also raised their fiscal year 2023 non-GAAP EPS guidance. I mean, this is all good stuff, but the market freaked out. And in my opinion, one of the reasons why the market freaked out, which is again the same thing with Meta, they are starting to decline in terms of users. If you look at the active accounts, it has been going up steadily. And then this Q1 of 2023, it went from 435 to 433. So it declined, I believe, for the first time in terms of PayPal. Now, PayPal is saying that this is because they are focusing more, on, monetizing their current accounts instead of just focusing on marketing to get new accounts. So they are focused more on their current accounts. But the honest answer for this is that PayPal is facing a lot of competition from Square, from many other type of players. Although PayPal owns Venmo, and Venmo is pretty popular among young people and many other things, but there's a lot of competition in the industry, and PayPal is starting to feel some competition. And the same thing with Meta, if you remember how they declined in users for the first time and the market freaked out and all of kind of things. And I see a lot of similarities between the two, and especially when you look at the PE ratio of PayPal, now it's sitting around 15 times earnings for PayPal. Now, this is a company that traded as high as 67 times earnings, with a mean of around 33 times earnings over the past pretty much 7 or 8 years, and now sitting at 15 times earnings, which again reminds me, a little bit of Meta whenever I look at such, metrics. But there's something you have to pay attention to with these tech companies like Meta, like, PayPal, like Square, and many others, is that they report, mainly the EPS normalized, which is the non-GAAP EPS. Now, if you look at the difference between the non-GAAP EPS, which is the white line, and the GAAP EPS, which is the blue line, there's a massive difference in 2022 and in 2023. So if you take the 335 of GAAP EPS, PayPal is actually not trading at 15 times earnings, it's trading like 21 or 22 times earnings. So this is a massive difference between the two. Some of it actually has some pretty good adjustment in terms of one-time, costs and many other things, but it's mainly, in my opinion, due to the massive stock-based compensation with these tech companies, which is why I'm personally not a big fan of these companies, because I don't really like the massive stock-based compensation expense, and they adjusted for it on, the non-GAAP EPS, and this is why it looks pretty amazing with most of these companies. But PayPal has actually been doing better than others, in terms of the stock-based compensation. It has been declining since 2020, which is very good and very encouraging from PayPal. Now, whenever I look at PayPal and I look at Meta and I look at all these other companies, normally you need a catalyst to be able to change the sentiment. You have very, very bad sentiment. The sentiment feeds on itself and the stock goes down and it keeps going down and it goes down to crazy levels. And then later on, a year or two from now, people will look back and will say, how come didn't I buy, PayPal at, $50? How come didn't I buy Meta at $87 per share, sitting at 11 or 12 times earnings? I mean, this is what really happens in the market, because there's such bad sentiment, most of us cannot really focus on the good things with such companies. But normally you do need a catalyst to change the sentiment. And the catalyst for PayPal might actually be new CEO and new management. Although the previous management, it wasn't the best, but it wasn't, really bad at all, in my opinion, because if you actually look at what they were doing with capital allocations, they were buying back stock whenever the stock was cheap, like they're doing right now, and they are focusing more on acquisitions and capex in 2020-21. But in 2022, 2023, the stock is crashing, and they are putting most of the free cash flow in terms of share repurchases, and this has been seen in their shares outstanding actually going down. So the management wasn't really bad, but it wasn't the best at all. They did not manage costs appropriately. Now PayPal is starting to cut costs. They are facing some margin expansions. They're gonna eventually face a little bit more growth in the future. So maybe a new CEO could actually be the catalyst for PayPal, but maybe the new CEO is even worse than the old CEO, and in this case PayPal is going much lower. But this is the things you have to look for with these type of stocks, and what is it going to cause the change in sentiment for the price change and for the value to be realized. And in terms of PayPal, the main thing that I really see is potentially a new face to the company, someone that's known, or a new good CEO that's actually going to do the right thing, cut costs appropriately, invest in the right areas of the business. This could cause a massive change in sentiment, and don't underestimate the change in sentiment and how fast these stocks can actually reverse whenever they go this low. And I believe the new CEO could actually do a lot of other things in terms of cutting costs. For example, on the G&A, general and administrative, they're still spending around 507. It's down from 607, but I believe they can spend much less. And especially around the technology and development, they spend 721. They used to spend 815. I still believe there's a lot of work they can do on cutting costs, which would actually improve their margin, as they can buy back even more stock at such prices, around $65 per share. Now, all of this doesn't really matter too much. What I try to focus on is my own valuation model, so I can determine if PayPal is a good buying opportunity or not. And PayPal made around $27.5 billion of revenues in 2022, and I put in a 7% revenue growth from 2023 to 2027. Now, if we look at where PayPal was before 2021, PayPal used to grow around 20%, 18%, 50%, so between 15 to 20%. In 2022, they only grew around 8.5%. In 2023, they are expecting 7%, and the analysts are expecting 9 to 10% and then 6%, so around 9 to 10% growth for the next 3 or 4 years. Now, what I'm putting in my valuation model, I'm putting 7%, which is lower than the 9 or 10%. And I get some crazy people in the comments telling me, yes, but the 7% is just a guess. Well, there's no certainties in the investing. I don't know how much PayPal can grow, but I'm not going to put in PayPal growing 15%. I would be much more comfortable putting PayPal growing at somewhere like 6 or 7% in my opinion. And if PayPal does grow back to 8, 10 or 11%, this is a plus on the valuation model. So I believe 7% is pretty fair. Their current net income margins is around 18%, so I kept it at 18%. For a PE ratio, I put in 18 times earnings. And this could be in discussion because now PayPal is sitting somewhere around 15 times earnings, 15 and a half. So I'm actually putting a multiple expansion on the company. But I do believe PayPal is actually trading this low mainly because of the extreme bad sentiment. And I don't think this extreme bad sentiment is going to be here 5 years from now. We could actually use both case scenarios, but I believe 18 times earnings is fair for a company that's actually earning 18% net income margin. If the net income margin was 6 or 7%, then yes, maybe I would put PayPal at 14 or 15 times earnings, but 18 to 20% net income margin, and this is on the non-GAAP stuff, which I don't really like, but this is what Wall Street use. So 18%, 18 PE ratio is somewhere fair. I don't think this is an overvalued territory. I think it's actually fair. In terms of a dividend, which is actually a buyback, I put in that PayPal can actually buy back 3% or back of their shares every single year. They might be able to buy back 4 or 5%, which is what they've been doing. but I put in 3% as a buyback yield, which I believe is very, very fair. I came up with a $125 billion market cap 5 years from now. The current market cap is $74 billion, which would return 84% on the upside or 14% compounded every single year for the next 5 years. Now, this is actually not bad at all. But let's assume the worst case scenario and maybe PayPal actually trades at 15 and a half times earnings, what it's trading at today. In this case, the upside would only be 61% or 11% every single year for the next 5 years, which is actually still not a very bad return in my opinion, but I would much rather bet PayPal, around 18 times earnings to 19 instead of 15, which would be around 14% every single year. Now, if you want to be a conservative investor and you want to, double your money over the next 5 years, which is what I like to do, I look for opportunities where I can double my money over the next 3 to 5 years. PayPal for me would be a buy somewhere around the $63 per share. This is what my valuation model actually says. $63 per share would actually be a new low for the company. And I'm not sure if PayPal is going there. There's a high likelihood. But for me personally, I think there's a lot of fear around PayPal. There's more that could actually good that could come than bad, in my opinion. It doesn't mean PayPal can't go lower. I'm not trying to time bottoms or say anything. But if I find that PayPal is a good buying opportunity, I'm going to maybe include it in my June of 2 stocks to consider video, which I do every single month. But I believe there's extremely bad sentiment around PayPal. This is the kind of stocks I look for. And there could be a potential catalyst, which could actually be a new CEO that has his head straight and knows what he's talking about. And this could cause a massive change in sentiment in PayPal, where it could potentially, have a meta type of move, maybe in 2024 or in 2025, where you have such massive, change in sentiment. So I believe PayPal is not bad at such prices. I would much rather buy it at, whatever my valuation model says, $63 or below. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.